All right, time to look at a case study. We're going to look at a small business in this example with a team of 5 executives. If you've seen our last video, we modeled exactly what corporations do regarding taking policies out on their executives, what the benefits look like for the company, for the executive. Remember Executive Joe in our last video? Executive Joe is extremely valuable to your company. Taking out a life insurance policy on him allows a number of benefits. One, you've got the cash value on your balance sheet, assuming you're the company owner. You can access that cash value anytime you want. Joe is an extremely valuable member of your team. If he leaves your company, it's going to cause so much stress. You're going to have to go back to the things that you haven't done in a long time and find a replacement. So in order to retain Joe, you take this life insurance policy out at him and you say, Joe, if you stay with the company for the vesting period, let's say it's 20 years, I'm going to pay you a retirement benefit. That retirement benefit, Joe, will be $50,000 per year. However, if you don't stay with my company for 20 years, you do not get that $50,000 per year retirement benefit, which lasts from age 65 until the day you die, age 90 in this example. So he gets his retirement benefit. Think of it similar to a pension in that respect, but Executive Joe gets that only if he stays with your company. So he's got to be vested before he receives it. And then for the company, you do receive that death benefit when eventually Joe kicks the bucket. When he passes, that death benefit comes back to you completely income tax free. So how do you actually set these policies up? If you're considering this, or if you own a company and you say, hey, I'm interested in this, but I really want to understand how it works because it can be confusing sometimes. It can be. We're going to go through a case study. Hopefully it helps. So in this case study, we are going to look at a SERP, Supplemental Executive Retirement Plan, which is exactly what we just looked at on the last page. 2 types. You've got defined contribution or defined benefit. A defined contribution plan is when the company states, here's how much we'd like to contribute to these plans, and here's the number of years we want to pay in. You could say, I want to fund these policies for 5 years, 10 years, till a certain age. You can even mix it up. Or for one employee, perhaps they're younger, I say, hey, I only want to pay in 10 grand per year for a younger employee because I want them to stay for a long period of time. So I'm going to fund it for 30 years. And then for an older employee, hey, I want to fund this policy with a lot of money over a short period of time. So you can be creative with respect to how you fund these policies as well. You've got a ton of flexibility, but defined contribution means that the company defines the dollar amount that they'd like to pay in. And that can be flexible as well. A company might say, here's how much we want to commit to, call it $100,000 per year, but we want to have the ability or the means to put in up to $500,000 per year or $1 million per year. This way, they're not locked into an expensive premium. They want it very flexible, and the product must be cash rich. So we're going to look at a defined contribution plan in this case study. And a defined benefit we'll look at in another case study. That's where the company says, here's the retirement benefit that I want to offer to my executives or the people that are included in this plan. How much do I need to pay into the plan in order to guarantee that they receive that benefit from age 65 to 90 or however long it is? So we've got the executive team here. The executive team in this particular example consists of 6 people. We've got a 55-year-old individual. This is the owner of the company. The policy is going to be funded at a heavy dollar amount, $250,000 per year for 6 years. That's a total of $1.5 million that goes into the policy. All of the other plans will be funded for 10 years with the option to go longer. However, it's very common to see companies design these policies with short funding periods for 2 reasons. 1, they don't want to be obligated to have to continue to make payments. But then 2, when you look at how to maximize the cash value and the internal rate of return, the internal rate of return on cash value performance will be optimized when we fund the policy for a shorter period of time. Now, of course, you can continue to pump in if you wanted to continue to grow that bucket of cash value, to grow that death benefit over time. But it's very common to see these short funding periods. Corporations prefer them. For the most part, not all of them, but 55-year-old, then we've got a 50-year-old individual, 100K for 10 years, 2 40-year-olds, a male and a female, 100K for 10 years. And then you've got a 35 male and an age 30 female, which are each going to have the policy funded at 50K per year for 10 years. Now, these are some large dollar amounts going in. Who funds the policy? Are it these executives or is it the company? It's the company funding the policy. As the company makes those payments, it's made with after-tax dollars, meaning we cannot deduct the payments like we could into a qualified plan. So for the company itself, some information here. If we group all of that together, what it looks like is $650,000 per year going into the policy for 6 years. Remember, the owner, we're only going to fund a policy for a shorter period of time, and then $400K per year, years 7 through 10. That gives us a total of $5.5 million going into the policy. Important piece I want to touch on here. Are they committed to this $650,000 annual payment? The answer is no. If they want to fulfill the retirement benefit plan, then yes, they want to be disciplined and make sure they hit this. However, they do have a ton of flexibility. With $650K going in each year, where can your money go? Toward the premium or toward the PUA component? Premium dollars is what I'm committed to. I can typically drive that as low as 10% with my major mutual companies. When I say major mutual companies, your big four: Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Some let you go a little bit lower, but 10% base premium. That's what we're committed to. The base premium also generates the least amount of cash value, especially on a guaranteed basis. So we want to drive that as low as we can in order to make the policy cash rich. Now, 10% of the $650,000 is what? That'd be $65,000. So the total is $650K, but they're only committed to $65,000. A little bit more as we have term riders and other pieces attached to the policy. My point, though, is they're committed to a minimal amount and can add additional funds at discretion up to a total of $650 if they want to take that approach. A lot of companies will say, hey, we like that flexibility in the event that cash flow is tight. However, our plan is to make payments on a regular basis. But the flexibility is nice. A lot of individuals and small businesses really enjoy it. So in this model, we've got a total of $5.5 million, but if life happens, we can pivot as needed. Important to be aware of that. You're not obligated to this huge amount. 3 points. A, the cash value is an asset on the company's balance sheet. So if this is your company, and these are your executives, remember, you own the policies or policies. So you've got access to the cash value to take advantage of for opportunities. Of course, we want to make sure that that cash value is restored when we eventually pay the retirement benefit to the employees, the retired employees, but you do have access to it. It is not uncommon at all to see a company say, hey, we've got this $5 million cash value balance with all of our policies. Can we assign this as collateral to a bank or lender to get a line of credit to take advantage of business opportunities? We might as well use it along the way as well, provided we have the reserves needed to pay that loan off when the time comes to fulfill the retirement benefits. But it is accessible. What companies look for here? So if you own a company, you're thinking, okay, like what should I be looking for if I'm interested in this? What questions are the big corporations asking? Here's where their eyes go. Regarding the cash value, what does the growth look like and what does the internal rate of return look like? Not the dividend crediting rate, not the guaranteed rate, the net internal rate of return. And that IRR, when we work with companies, small and large, will typically look at the internal rate of return on the present dividend interest rate on current rates, but also conservative dividend rates and guarantees. This way, expectations are set properly. We see the best case and worst case scenario up front. So this is typically what is examined. We want to ask for that. It should automatically be disclosed, but we do want to ask for it if we don't see it. CFOs will examine that at large companies. Then we've got B, income and retirement benefit. So we're going to model the actual retirement benefit that is paid to the executives. Now, vesting period. Remember, there is a vesting period. This is determined by the company. So if this is your company and you've got the 35-year-old male down here, let's call him Executive Joe, like our last video, $50K for 10 years is what you're going to pay into it. You could say to him, hey, when you hit age 65, because you're the company, you can fund the policy however you want. When you hit 65, Joe, I'm going to promise you a retirement benefit of 80 grand per year. This is an additional benefit, including all of your other your personal retirement plans, 401ks, stocks, bonds, mutual funds, real estate, all of that good stuff. This is just a benefit. You get a deferred compensation plan from the company, where that's a way of us expressing our thankfulness for your years of service with us. So if he stays with the company through the vesting period, let's say it's age 65, he's going to receive a retirement benefit. So that's the catch. He's got to stay with the company. If he leaves, he doesn't get it. The company retains the cash value. If he dies, the death benefit still flows back to them, unless the company, if you're the company, you elect to transfer it to a new executive or new employee. We hit on that in our last video. So the vesting period must be met. And then C, death benefit and cost recovery. So typically what we'll do in a plan like this, let's take the 50-year-old individual, 100K for 10 years. That's a total of $1 million that is paid into the plan. So what I as the company want to make sure of is one, that when I pay those benefits out, there's still a death benefit intact. We're not going to drain the policy and take the maximum income here. No, I just want to take the dollar amount out needed that satisfies him. I can honor my promise to say, here's your 100K per year retirement benefit. But remember, I paid $1 million in, the company did. So that death benefit, I wanted to recover the $1 million payment I had made, the payments I made, I should say. And then we want to account for inflation as well, because $1 million today will not have the same value 30 years from now. So I do need to account for that. So we're going to look at some inflation models as well, just when we actually model these plans out. Last thing, the actual product. So when you look at whole life insurance products designed for maximum cash value, there's so many different products and options to be aware of. When we look at the policy design, this is one of the most important things. How do I reduce the insurance expenses to maximize the cash value? Corporations always do that. Now, when it comes to corporations, there are products that are available to companies, typically based on the dollar amount going into the policy, that are not always available to individuals. In this example, we're going to look at a product referred to as an Executive Strategies whole life insurance policy. This is a form of a high early cash value product that does not sacrifice much long-term performance. It's a really sweet product. What you'll find is that the base premium in itself credits about 95% of the payment to cash value in the first year alone. So it's a nice asset on the balance sheet. You can kind of see it in the name, Executive Strategies whole life policy. Why it's called that is it's primarily designed or primarily offered to companies that are placing these policies on executives. Individuals can acquire it. So an individual can obtain this policy. If there's a single policy being offered, the minimum base premium requirement is $100,000. This is specific to Guardian in this example. So what that means is if I'm paying in $500,000 per year, say I'm paying in $300,000 per year, I'm interested in a personal policy, my minimum base premium would need to be $100K. It would actually make more sense to take out a traditional policy with a $30,000 minimum premium, as opposed to this higher one with the $100K base premium. Where this makes sense for individuals, really if someone's paying in large dollar amounts. For example, we have an individual that puts in $1 million per year. His minimum base premium is $100,000, so he's got that 10/90 split. Based on the dollar amount he's paying in, the product made sense. Now here's the thing when it comes to companies. For multiple policies, so for a group, in this case, a corporation, the minimum base premium requirement is $50,000. So if there's 2 lives or more, meaning the executive team consists of 2 people or more, for the company, the minimum base premium needs to be $50,000. So what this means is if you're paying in to 5 policies and they each have a $10,000 base premium, what's your total, your collective base premium? $50K. That would qualify. What if it's on 10 employees and they each had a $5,000 base premium? That would qualify. So when a company sets this plan up, collectively, the minimum base premium is $50,000. Now, there are some drawbacks to this product, so we like to look at both options as far as traditional products and high early cash value products, this Executive Strategies whole life policy. But when considering the asset on the balance sheet and not wanting to take that negative hit or minimizing it, it's a fantastic option to be aware of. when we look at, again, that base premium, 10% or whatever that dollar amount is, with a traditional whole life insurance policy, in the first year, we're going to have what? Based on the premium, 0 that shows up in cash value. We're very close to it. With an Executive Strategies whole life product, it's typically right at 95%, 90 to 95. Usually you'll see it at 95%. So let's take a look at some options here, shall we? We'll have some fun with this. So first, let's examine the actual product here, and then we'll get into the modeling regarding this group over here. So, product. Is it designed properly? Here we go. Executive Strategies Whole Life. This is on the 30-year-old female. Where is the money going? Premium, right here, $5,000. That buys them a whole life death benefit of about $380,000, which would give her, in this case, a MEC limit of between $10,000 and $13,000 or so. They're paying in $50,000 per year. And you can see that down here is our paid up additions rider, $45,000 for a total of $50K. So we've minimized the premium and maximized the PUA rider. What this guy is, target additional benefit, is a term insurance rider, which is a cheap way, if you don't like the word cheap, cost-effective way to raise the death benefit, which raises your MEC limit. So the MEC limit, which is that IRS limit on a life insurance policy, has a direct relationship to the death benefit in a life insurance policy, an individual's age and total death benefit. But why we use term insurance, cost-effective way to raise the death benefit and keep our premium at a minimum. It helps maximize cash value in short. So here we go, $50K per year going in. There's your total payments, or there's your annual payment. Here's your total payments over time. Year 5, you've paid in $250K. What's your cash value? $253. This is based on the present dividend interest rate. We do like to look at the guarantees. This product also offers an indexed rider, which some people are attracted to, so we'll show all 3. But this is one policy of the 6 individuals, and you'll see the same pattern on each individual. Here's the 40-year-old, $100K per year going in. Here's the 55-year-old, the owner, which we've got heavier funding going into the policy, $250 per year for 6 years. Through the age of 60, when we look at this, he's starting at 55. 6 years. There's his last payment, year 6, net premium, 0 in year 7. Question comes up here sometimes. In year 7, premium of $25,000. That's still due, but he's not paying it out of pocket. What's happening here is we exercise what's called a premium offset. This allows the policy to pay for the premium internally through dividends and interest. So first, the policy covers the premium, then everything left over kicks back into cash value. There's the net growth rate, or the net growth, I should say. And then we kill the premium altogether through what is called a reduced paid up option, a means to maximize cash value performance. So when we look at this, what does the actual model look like? Here is a breakdown of the actual product itself. Now it's time to look at the actual model and what corporations look for. What questions should they be asking? Is the policy set up properly? Yes, if I see it cash rich from start to finish. Let's continue on here. So, what we'll look at first is always the growth. We will look at the income models, but what I will always encourage one to do is start with the product design and then the growth. Because what questions are being asked from companies that have experience with these? What's the cash value growth look like? What's the net internal rate of return? Because this does affect our P&L, especially right off the bat, our profit and loss statement. And how much are we taking in a negative hit? Like, is it worth it when we look at the actual cost? So when we minimize it, typically it is worth it because we minimize that hit. But collectively, I want to see what the growth looks like and then transition into the income and the long-term benefits for the company. So here we go. We've got the payments going in here. Let me actually do this, capture all 5 years, perfect. What do you notice here? Year one, you're paying $650,000 total. This is with all 5 policies. The minimum premium commitment, $65,000. Everything else, we're plowing into the paid up additions rider. $650 in, just about $600,000 in cash value, $596. No matter how we slice that, that's a negative hit. What's your negative hit when you look at your cash value growth? Over here, you lost about $54,000. Meaning I paid in the $650, I've got just under $600. That's where the $54K loss comes up. Which, if we want to associate an internal rate of return with that, negative 8.3%. This is the annualized internal rate of return, not the average. We're going to look at the average shortly. The annual just isolates each year what the policy is growing by net. Year two, you're paying $650. Cash value grows from $596 to $1.224. Did we get the full $650,000 back in year two, isolating that growth? The answer is no. We get the $650 back minus approximately $22,000, which is a negative internal rate of return of 1.74%. Negative. How about year three? I pay in $650 again. Grows from 1.2 to 1.88. I get my $650,000 back and a little bit more, just over $6,500 in net earnings. I look at the cash value growth. And then each year, I see it get better and better. Worst part about any whole life insurance policy, that's a non-MEC like this is, so you've got access to the cash value. Worst part is what? First year. That premium, I take a negative hit on that. I've got a term rider expense. I've got PUA fees. The policy has not begun compounding yet, so I've got a negative hit right off the bat. That's the pain point that people have. Now we've minimized it here, so a lot of times what does happen, companies look at that and say, okay, like that's perfectly fine, we can handle that. It's all relative to one situation. There's the total death benefit, $17 million on all of the executives, which, who's the beneficiaries? There's one beneficiary in this example. It's the company that flows back to the company income tax-free. And you will see periods in time where we slightly reduce that death benefit to improve cash value performance. However, that is optional. Some companies will elect to take a little bit lower internal rate of return or cash value growth and keep their death benefit at a higher number because they value the death benefit coming back if anything happened in the short term to employees. But back to the growth here. Year four, another $650, total of $2.6 million in. You're almost at $2.6 million. Your net growth rate that year was $38,000. Let me hit on something here, very important. You grew from, you were at $1,880,000 in year three. You paid in $650. It grew to about 2.57. So you got more back than what you paid in. What happens sometimes here, people look at it and say, hey, it grew from 1.88 to 2.56. Look at that growth. We have to factor in the payment I made of $650,000. When I back out the actual out-of-pocket, the money I deposited as the company here, there's your net cash value growth that particular year. Then year five, make another payment, what happens? 2.2% on the internal rate of return. This is an effective tax-free yield because we have not MEC'd it out. We don't cash it out, so there's no taxable gain or anything like that. There we go. Cash value continues to grow. That's the net cash value growth. So there's the overall growth. I've got the annualized internal rate of return. Okay, that looks great. That's the overall, just a big picture of what the model looks like on all 6 executives in this case. Now, what does it look like for each executive, or what are the kind of things we want to look at? So if we take the two 40-year-olds in this particular case, what do you notice here? 40-year-old male, 40-year-old female. The last model we just looked at, all 6 policies combined in this case. So that's everything combined. Going back to this, what do I have? just the 40-year-old male and female in this particular case. Did I say 6 employees or executives? I'm at 5, I'm sorry. You know what I mean. I'm having too much fun with this. So, age 40-year-old, age 40-year-old. Death benefits slightly vary based on the design of the product. The design is actually identical. It's more so when you look at males and females, females live longer than males. So what ends up happening is I need a little bit higher death benefit to attain the same MEC limit. So we're forced to raise the death benefit a little bit, but almost identical when you look at the performance over time. Where you'll see the difference here and what the CFO is typically looking at is what's the first year cash value, the negative hit on equity. What's the death benefit? We do have key man insurance this way as well, which is a benefit. So there's the negative hit. Annualized IRR, this is what the impact is each year. And then when I look at the average internal rate of return, you'll notice it's in the black in year 5. That occurs when I've got more money in cash value than what I have paid into the product. That's exactly what's going on there. So year 4, I've paid in $400,000, I've got $395, a little bit less than what I paid in. That's why I have a negative internal rate of return on the average IRR. Year 5, I've made a total of $500,000 in payments. I've got just over 506. That's why I'm positive here. Important to look at both on both a guaranteed and non-guaranteed basis. This is just based on the current dividend interest rate. We do look at guarantees and everything else. If I include guarantees to everything in this video, it'd be 3 hours long. And I'm going to restrain myself. So, going back to this guy, here we go. The growth, asset on the balance sheet. Okay, we covered that. How about the income benefit now? So, when it comes to the income, retirement benefit for the executive. So if we look at, let's take the two 40-year-olds here, which we can really just look at one of them. But company is paying $100K per year for 10 years. We're going to promise that those employees a retirement benefit if they stay with the company through age 65. What does that look like? Let's take a look. So we've got the two 40-year-olds here. This was the growth model we just looked at. Now let's look at the income model here. Same policies, but based on income. So what you'll notice here, same break-even point. As time passes, what do we notice? Look at their ages. So in purple is the annual income. That's how much is being dispersed from the policy, first through withdrawals and then through policy loans without paying any loan interest, not paying anything back, not paying any of the policy loans back. So when we look at this here, what do we notice? Well, first, let me do this. So we've kept the total payments column here. Did this for a reason. Here's your total payments, paying a total of $1 million. What I want to know is how much have I paid in? Because when we get to the cost recovery piece, so when you actually recover your payments as a company, the $1 million, are we going to get that back? The answer is yes. But then 2, what's it look like when I start to distribute income? Can I pull out more than what I paid in and still get my money back? And have access to the cash value all the way through? The answer is yes if it's planned properly. If it is planned properly. When it's not planned properly, that's where these things get messed up. So, age 65 through age 90, the income benefit's going to begin. What you'll notice about the total payments column is what? Income starts at age 65. I paid in $1 million, but now the company distributes $100,000, pays it to this former executive. Now, the $100,000 was dispersed by the company from the cash value. Here it is. When they take that disbursement, no taxes to the company at all. Could be a withdrawal if it's before the cost basis or a loan. There's no taxation on that disbursement to the company, provided it's not a MEC or anything else. But when they pay it to the employee here, it is taxed as income. The company can elect also to book it as a compensation expense if they choose to do so. Here we go. So by the time they hit 74, 100K per year has been pulled from the policy. At this point, all withdrawals. And we are back to zero, meaning I paid in $1 million, pulled out $1 million. I've got about $2.3 million left over in cash value and a net death benefit of $3.1 million. So if he dies at this point in time, at 74, this death benefit comes back to the company tax-free. Now we continue to pull out that $100,000 per year payment because we made a promise. Here's how long I'm going to pay you, Mr. Employee, once you retire, if you meet the vesting provisions. And here we go. So we ran this through 90. We typically do that. A lot of times these models are run through 85. I like to run them a bit longer. This way we know, hey, if we die at the expected mortality age of 85, here's what will be paid out in benefits, $2.7 million. I still have $2.1 million left over in cash value. What happens if I beat the odds and I live for a while? Well, we always want to equip these policies properly in the event that we keep on paying benefits because we want to honor that promise that the policy still has plenty of value left. This does a couple things. One, it ensures a healthy death benefit flows back to the company. But two, in the event that life happens, in this case for the better, the individual continues to live and we keep paying them, we've got sufficient cash value to do that. And if dividends come down and the projections we look at are closer to the more conservative projections that we look at, we didn't look at those in this video, but you know what I mean? If we look at things conservatively, we'll be okay. I don't have to have a fear of the policy blowing up or draining too much income, and then we got to say to the company, not going to work out here. We're going to have to make some adjustments. No. Set expectations clearly up front with this stuff, with everything, but especially with this. So there we go. Leaving plenty of income in the policy here in this particular case, cash value that is. This way, we've got a lot of window room to maneuver if we need or want to. Pretty interesting, isn't it? So let's look at the third phase here. Here we go, which is with the cost recovery piece and inflation. This is important. So eventually what happens? Death benefit comes back to the company. When we go back to that particular example, what do we have here? At age 85, this is pretty cool. The company has paid in $1 million. They got that $1 million back, and then they also took out another $1.1 million. So those are distributions so far from age 65 through 85 of what? $2.1 million paid to that former executive. It's a nice incentive to stay with the company. This is in addition to all of his personal retirement planning. So that's what he receives. Now, the company, what did they lay out? That $1 million. They've got to get that back. If we don't account for inflation, that's extremely easy to do. Some companies do, small businesses look at just a dollar amount. They say, hey, this is a family business. If we got $1 million back, that's more than sufficient. But large corporations like to account for inflation here. So what would we look at in this particular case? Well, let's have some fun here, shall we? So let's take this a step further. Here's the age 40 individual. This is the impact to the corporation. This scenario is the income at $100,000. What we just looked at, there we go. Age 85, what do you have here? There it is, the $2.7 million. That's better. The $2.7 million in death benefit. Then over here is a model where we only look at pulling $60,000 per year out. This is all done with companies before having conversations with the executives and going through actual numbers and saying, here's the retirement benefit we're going to offer you. Here's why. If inflation is a concern to make sure we've got the proper cost recovery built in, we want to model this well beforehand. So here's what it looks like when we look at inflation, is we paid in how much? A lot of different ways to calculate this, but let's look at a simple example. For the 40-year-old individual, a total of $1 million was paid in. Now, what I did here that some might not agree with, and I would sometimes argue against it as well, is we funded the policy at $100,000 per year. What we did here is just assume a present value of $1 million, starting things off, just starting with $1 million. So what we should do in this is change it to a funding of $100K per year for 10 years. But for the sake of simplicity, let's make it $1 million. This makes things actually a little bit more conservative, which is good. Let's show things very conservative, maybe too conservative. And then when we look at realistic models, it's like, oh, that actually looks pretty nice. At least that's how I look at things. Got compound inflation here. We also did a flat rate. The flat rate, if we start out with $1 million, 3% of that is $30K per year. We're not going to look at this one. Here we go. So we've got compound inflation starting at age 40 with a present value of $1 million here. If we go down to age 85, how much death benefit do we need when we look at this? Come on, here we go. Age 85, about $3.7 million. That's what $1 million today will be worth over about 46 years from now, based off the 3% compound inflation calculation. So going back to our model, here we go. 100K per year. That could negatively impact us. 60K per year. Well, that builds in a nice buffer. Perhaps we look at another model with $75,000 per year. And if we adjust that inflation calculation and base it off the actual 100K per year payment for 10 years, that'll impact things a little bit as well. But I think you see where I'm going. If you have questions, please comment below or reach out to us. We can always talk through this as well. Hope you enjoyed this one. I had a ton of fun with it. If you did enjoy it, please hit the like button, subscribe for more, and we'll talk to you soon. I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.